Unbelievable. CRA slaps Galea family with $660,000. Tax bill. The story no one told you. Imagine checking your mail and finding a $660,000 tax bill out of nowhere. That's exactly what happened to one Canadian family. The CRA hit them with a massive surprise, and the reason behind it will leave you stunned. This story could change how every homeowner in Canada looks at their taxes. Welcome to Canada Insight Now, your daily source for pension and immigration updates. From CPP and OAS to PR and visa news, we bring you the latest facts that shape your future in Canada. The Galea family, living a seemingly normal life in Ontario, had no idea that a decade-long dream would turn into a financial nightmare. They had worked hard, built their property portfolio, and followed every rule they thought applied to them. But when the CRA came knocking, it wasn't just for a few $100s in back taxes. It was a massive $600,000-$60,000 assessment. And the reason behind it is raising serious questions about how Canada's tax laws are being applied. The story begins several years ago when the Galeas bought a home they planned to live in and later sell. They did this more than once, a common practice many Canadians do without realizing how complex the tax rules can get. The problem? The CRA decided that what they were doing wasn't a simple home buying and selling. It was business activity. According to the CRA, the Galeas were flipping homes and should have been paying business income tax instead of claiming the principal residence exemption. For those unfamiliar, the principal residence exemption means if you sell your main home, you usually don't pay tax on the profit. But here is the catch. If the CRA decides you never truly lived in the home or that your intention was to make a profit, they can reclassify your sale as a business transaction. And that's exactly what they did in this case. Suddenly, what the Galeas thought was tax-free income became fully taxable business profit, plus penalties and interest. The CRA's auditors didn't stop there. They went back years into the family's financial records, checking every sale, every mortgage, and every deposit. They claimed that the Galeas had been systematically buying and selling properties to earn profit, not to create a home. What the family saw as legitimate real estate investment, the CRA saw as undeclared business activity. And that difference is what led to the $660,000 bill. Imagine receiving a letter in the mail saying you owe more than $500,000 in taxes, money you don't even have, all because of how the CRA interprets your actions. The Galeas were stunned. They argued that they genuinely lived in the homes, that they weren't running a business, and that they had no intention to deceive anyone. But the CRA had its own view, backed by years of case law and tax precedent. This story quickly went viral online because it struck a nerve. Thousands of Canadians began asking, could this happen to me? The truth is, yes, it could. If you've bought and sold properties in a short time frame, even if you lived there, the CRA can still question your intent. They can decide that you weren't really a homeowner, you were a property dealer. And once they make that determination, the tax bill can be crushing. But what makes this case so controversial is how far the CRA is willing to go. In the Galea case, they not only reassessed the family for unpaid taxes, but also applied gross negligence penalties. That's an extra 50% of the tax amount, meant for cases where the CRA believes the taxpayer should have known better. This isn't the first time something like this has happened. Over the past few years, the CRA has been aggressively auditing homeowners, especially those in booming housing markets like Toronto, Vancouver, and Calgary. The government is cracking down on so-called property flippers, but many argue that innocent families are being caught in the crossfire. Experts say that the line between genuine home ownership and taxable flipping is incredibly thin and often subjective. It depends on how long you live in the home, what your stated intentions were, and how often you buy and sell properties. Even minor details like utility bills, school registration, and change of address forms can be used as evidence to prove or disprove whether a home was really your principal residence. The Galeas case is a wake-up call. Their story shows that even well-meaning Canadians can get trapped in the CRA's complex web of tax rules. The family appealed the CRA's decision, arguing that they were unfairly targeted. But the process has been long, stressful, and expensive. Court documents show that the family faced sleepless nights, financial strain, and the possibility of losing their properties, all because of an interpretation. What's worse is that their case highlights just how much power the CRA has. They can freeze your bank accounts, garnish wages, and even place liens on your property, all before a court makes a final decision. For many, fighting the CRA feels impossible. The cost of legal defense can easily reach tens of thousands of dollars, and even if you win, the stress and damage can last for years. Financial experts across Canada are now warning people to be extremely careful. If you've sold more than one property in recent years, you need to make sure you've correctly reported it to the CRA. Even an innocent mistake can look like intentional tax evasion to an auditor. And once you're on their radar, they can go back as far as they want to reassess you. Tax lawyers say this case could set a precedent for future audits. If the CRA continues to interpret intention this aggressively, more families could face similar bills. They urging Canadians to document everything, from utility bills to family photos showing you lived in the home, just in case the CRA ever questions your principal residence claim. At the heart of the Galea story is a simple question: when does smart investing cross the line into tax evasion? For the CRA, the answer seems to depend on how profitable you are. For Canadians, it's a warning to tread carefully. The Galea's $660,000 shock isn't just about taxes, it's about how even the most ordinary families can get swept up in a system that is often confusing and unforgiving. As of now, the Galea family is still fighting their case. Supporters online have called the situation unfair and heavy-handed. Others argue that the CRA is simply doing its job to ensure everyone pays their share. But one thing is certain: this story has sparked a national conversation about tax fairness, property ownership, and the fine line between right and wrong in Canada's housing market. If there's one takeaway from all this, it's that Canadians need to be informed. Don't assume that just because you bought and sold your home, you're automatically safe from taxes. The CRA has made it clear. They're watching, and they're willing to dig deep to collect what they believe is owed. You've been watching Canada Insight Now, Canada's trusted voice for pension and immigration news. Subscribe now and stay informed, because your Canadian journey starts here.